Hey everyone, James here and welcome back to the Cash Flow Extreme channel. This video is a little longer than usual, however you really should stick around to the end, this is important stuff. Today we're diving into the world of dividend investing. Now, who doesn't love getting paid passively by their investments? That's exactly what dividend investing is all about. Building wealth by owning shares of companies that pay you a portion of their profits. But just like with any investment strategy, there are some common mistakes that can trip you up and cost you serious money. We're going to expose and break down the top 10 dividend investing mistakes that you absolutely must avoid. These are the mistakes I see people making all the time, and trust me, they can really put a dent in your portfolio. Let's get started. Alright, let's kick things off with mistake number 1, chasing high yields. Now I get it, seeing a stock with a juicy 8%, 9%, even 10% dividend yield can make your mouth water. It's tempting to jump right in and think, wow, I'm gonna get rich quick. But here's the thing, guys. If a yield seems too good to be true, it probably is. High yields are often a red flag. They can be a sign of a company in trouble, a company that's desperate to attract investors. Instead of just looking at the yield alone, you need to dig deeper. Look at the company's payout ratio. This tells you what percentage of its earnings is being paid out as dividends. A payout ratio above 100% means the company is paying more in dividends than it's earning, and that's a huge warning sign. Don't fall into the trap of chasing those sky-high yields without doing your due diligence. Mistake number 2 goes hand in hand with chasing high yields. It's ignoring dividend safety. Look, I understand the appeal of a fat dividend check, but what good is it if that dividend gets slashed, or even worse, eliminated completely? That's why you need to prioritize dividend safety just as much as the yield itself. Remember that payout ratio I mentioned earlier? That's your first line of defense. Aim for companies with a payout ratio below 70%. This indicates they have a comfortable cushion to maintain their dividend payments even if their earnings fluctuate. Next, check out the company's balance sheet. Are they drowning in debt, or do they have a healthy debt-to-equity ratio? High debt levels can put pressure on a company's ability to maintain their dividend payments, especially during tough economic times. Remember, dividend safety is key to building a reliable stream of passive income. Let's move on to mistake number 3, not diversifying your dividend portfolio. This is a mistake I see investors of all levels make, and it can be incredibly risky. Diversification is all about spreading your investments across different sectors and industries. Why is this so important? Imagine you put all your money into just 1 or 2 dividend-paying stocks. What happens if one of those companies faces unexpected challenges? Their stock price could plummet, and your dividend payments could be at risk. That's why it's crucial to spread your risk. Don't put all your eggs in one basket. Instead, consider investing in a variety of sectors. Things like consumer staples, healthcare, technology, real estate, and so on. This way, if one sector underperforms, the others can help cushion the blow. Remember, diversification is your best friend when it comes to mitigating risk and protecting your hard-earned money. Mistake number 4 is often overlooked but can quietly eat away at your returns over time. I'm talking about fees. Now, there are all sorts of fees associated with investing, and when it comes to dividend investing, they can really add up and drag down your overall profits. First, you've got your trading commissions. Every time you buy or sell a stock, you're probably paying a fee. These fees might seem small, but they can add up fast, especially if you're frequently trading. Then, there are expense ratios. These are annual fees charged by mutual funds and ETFs to cover their operating costs. If you're investing in dividend-paying mutual funds or ETFs, make sure you check their expense ratios. Lower is always better. The key takeaway here is to be mindful of fees. Mistake number 5 is a missed opportunity. I'm talking about failing to reinvest your dividends. Now, it can be tempting to take those dividend checks and spend them right away. After all, it feels good to be rewarded for your investments. But trust me, reinvesting those dividends is one of the most powerful ways to supercharge your returns over the long run. Think of it like this. When you reinvest your dividends, you're essentially buying more shares of the company. And when those new shares pay dividends, you're earning even more dividends. It's like a snowball effect. Your money starts to work for you, and then that money earns you even more money. This is the magic of compounding in action. Now let's talk about mistake number 6, which is a big one, especially for those new to dividend investing. Ignoring the tax implications. See, many people don't realize that dividends are taxed, and failing to factor this into your investment strategy can lead to some unpleasant surprises come tax season. The tax treatment of dividends can vary depending on where you live and what type of account your investments are held in. In some countries, dividends are taxed as ordinary income, while in others, they may be taxed at a lower rate. To avoid any nasty surprises, do your research, talk to a tax professional, and understand how dividends will be taxed in your specific situation. This way, you can plan accordingly, minimize your tax liability, and keep more of your hard-earned money. Mistake number 7 is a common one, especially for long-term investors, and that's failing to monitor your dividend investments. See, it's easy to fall into the trap of thinking, I've invested in solid companies, I'm getting paid dividends, I don't need to check on things too often. But the truth is, even the best companies can experience setbacks, and neglecting your portfolio can lead to missed opportunities or even worse, losses. Make it a habit to regularly review your dividend-paying stocks. Check their financial statements, track their earnings reports, and stay informed about any news or events that might impact their business. If you notice any red flags or significant changes in a company's fundamentals, it might be time to reevaluate your investment. By staying informed and monitoring your investments, you can make better decisions and ensure your portfolio stays aligned with your financial goals. Let's talk about mistake number 8, falling for dividend traps. Now these are companies that appear to be great dividend investments on the surface. But beneath the surface, there are serious warning signs that often go unnoticed. One common type of dividend trap is a company with an unsustainably high dividend yield. These companies often have a high payout ratio, meaning they're paying out almost all of their earnings as dividends, leaving little room for error or future growth. Another red flag is a company that's consistently cutting its dividend. To avoid falling into dividend traps, it's crucial to look beyond the dividend yield and dig deeper into the company's financials. Mistake number 9 is a fundamental one, neglecting company fundamentals. See, some investors get so caught up in chasing dividend yields that they forget to assess the underlying health and growth prospects of the company. But remember, a dividend is only as good as the company that's paying it. Before you invest in any dividend-paying stock, it's crucial to analyze the company's financial statements. Look at their revenue growth, profitability margins, and earnings per share. Are they consistently generating profits? Are their revenues and earnings growing over time? Next, consider the company's competitive position. A company with a wide moat is more likely to withstand competition and continue paying dividends for years to come. And finally, mistake number 10 is perhaps the most important to avoid: lacking a long-term plan. See, investing without a plan is like sailing without a compass. You might end up somewhere, but it's unlikely to be your intended destination. Before you buy your first dividend stock, take some time to define your financial goals. What are you hoping to achieve with your investments? Are you saving for retirement, a down payment on a house, your children's education? Once you know your goals, you can start to develop a plan to achieve them. Having a plan will help you stay focused, avoid impulsive decisions, and make investment choices that are aligned with your overall financial objectives. Thanks for watching. I hope you found this video helpful. Now you know the 10 biggest dividend investing mistakes to avoid. You're well on your way to building a portfolio that generates passive income for years to come. Remember, dividend investing is a marathon, not a sprint. By avoiding these common mistakes and focusing on the fundamentals, you can set yourself up for success in the exciting world of dividend investing. If you enjoyed this video, hit that thumbs up button and subscribe to Cashflow Extreme for more investing tips and strategies, and be sure to let me know in the comments below what topics you'd like me to cover next. Until then, happy investing.